Welcome back to our intermediate financial accounting class. In this series of discussions, we are talking about the accounting cycle. Very exciting. We're almost to the journal entries, my favorite part. But for now, we're talking about how the accounting cycle fits and all flows together to provide us with the information that we need to then provide financial statements, cost accounting information, tax information, etc. So we talked about the cycle and the different elements of the cycle. We talked about the equations and how they work together. And we use this picture to help us see how those accounting equations work and why we set them up the way we set them up. So to make sure that everyone's comfortable with these ideas, I want to give you an example of the accounting cycle in action so we can really see how it all fits together. You ready? We're going to put assets on this side, and we want that to equal the liabilities and equity that are on this side. Oh my goodness, my wife tells me it's a good thing I got my PhD because I write just like a doctor. All right, let's put in some T accounts. We'll make a big one for cash. And then we have our liabilities. So those are our debt holders. And I gave him a really wide brim that time, didn't I? Okay, so we got our debt holders. And then we have our equity holders. And we use the word holder because of the pieces of paper that they have, but also because they actually hold our assets, or they control our assets. They have claim to those assets, however you want to think about it. So we go to our debt holders and we say, hey, we got this great idea, it's going to make us a lot of money. And they say, you're right, that is a good idea. And so they give us some money. And we record that as a credit, showing that they now have a loan that they can make us pay. So debt has gone up. We owe them money. And the flip side of that, in exchange, we got cash. And we debit the asset so that everything stays in balance. This is money from my debt holders. So that's that part. That's how we're recording it. Right now my debits and my credits are equal, left-hand side, right-hand side, and I show this money has to go back to this bank. That's what we're doing. Next, we go to our equity holders, and we do the same thing. We say, hey, we got this great idea. And they say, oh, you're right. Let us give you some money, too. So we show that as a credit. They have claim to this money. And the debit over here, our assets go up. We have more cash. We have more cash. Why? Because those equity holders gave it to us. And now we can show we have a total amount of cash here. So much of it belongs to the debt holders. So much of it belongs to the equity holders because they're the ones who gave it to us. Debits and credits are equal. Assets and who owns them, the liabilities and equity, are equal. That's the accounting equation. Well, the next thing we do is we invest some of that money. We're going to buy, let's buy some inventory. So I take some of this money and I use it to buy inventory. I take it out of cash, so cash drops, and I put it down here in inventory. Okay? Debits and credits stay equal. This asset went down, but this asset went up, and nothing changes over here, right? These owners still have claim to those assets. They just have it in a different form, right? Instead of having $100 in cash, now I have $90 in cash and $10 in inventory that I could get if the company was to liquidate. Okay, so that's what we're keeping track of. Well, now, of course, the best thing that could possibly happen happens, and that is I sell some of this inventory, which is really the idea. So we sell inventory. So one box goes down because I've sold inventory. Now we think about this. Inventory goes down, so the assets drop. Who has to pay for that? Well, either liabilities has to go down or equity has to go down. Think about this for a minute. If I sell inventory, who is on the line for that? If you sell inventory and the inventory goes out the door, do I owe the debt holders any less? No, that's a contract. They get a set amount. It doesn't matter whether I've lost inventory or sold it or anything. They have a set claim. Which means, who's out? Well, the equity holders are out. Because somebody's got to lose that asset, right? There's only $90,000 worth of assets left. 50,000 still belongs to the bank, so instead of 50,000 belonging to the equity holders, now only 40,000 belongs to the equity holders. And so I'm going to show equity going down, and again, I stay in balance between these two, right? These two match up. And I should go back. I'm going to. I didn't show this arrow like I should have. Now there's also a flip side to this, right? If I sell inventory, I'm not just out the inventory, but I also get some cash because they bought it from me. So over here, let's show that cash coming in. And I know cash had to come in with that sale, otherwise I won't be in business for very long. But they gave me money. Now again, the question is, who gets that money? Well, let's see. If I get money from a sale, it doesn't change what I owe my debt holders, so the owners must get that money. So this is going to come over here, and my equity holders. They're going to have claim to that money that came in. If I do it right, then the cash coming in is more than the inventory going out, and the equity holders do better and better and better each period. So that's what we're doing. That's the accounting cycle. Over time, of course, I'm going to make a bunch of money, and as I make money, eventually I'm going to want to repay some of these debt holders especially, and I may pay dividends to my owners too. But let's just do the one. Let's say that because of all the money I've made, I can repay my debt holder some of what I owe him. He gets the money, so he's happy that he gets the money, but he doesn't have claim on us anymore. So that makes him sad because he doesn't get to be part of our business anymore. Now, look at how much is involved in this equity section, right? We didn't show it, but we've got money coming in. We showed that. We could have money going out like we did up here. We've got revenue coming in. We've got expenses coming in. And we looked at that and just went, there's too much going on here. If we put all of that into equity, we'll never be able to keep track of what's really going on. So we said, let's take that equity account and break it down so that we can really keep track of what's going on. So he said, okay, let's take the investment, and instead of calling it just a big equity account, let's make a little account called investments by owners. And that would be this money that the owners paid to the business. And then we said, let's create a revenue account that keeps track of that money coming in. And then we said, well, if we're going to pay for that inventory and all these other costs, right, paying our employees and all that stuff, let's keep track of our expenses that we're paying. This is our inventory box. Now that's got a debit balance. Why? Well, because as expenses go up, equity goes down. It is just a breakout of this overall equity account. That's the idea. That's what it's for. It's not because equity is some weird account. It's because, well, this is a subset, a subsidiary of that big equity account. And if I break it out, I can keep track a little bit better of what's really going on. And the last one, we didn't show this up here, but we could have. Sometimes we're going to pay a dividend, or we're going to let them withdraw money. And boy, that's hard to read. Let me see if I can fix that. Ooh, I lost the top of my T account. Okay. There we go. So we give them back some of their cash. And we give them cash, and we give them cash, assets drop in our business, but the owners don't have claim to as much either. So they're probably happy that they got the money, but they're sad that they're not as involved with our business. So we could use a frowny face there if we wanted to. So that's what we're doing with all of these different accounts. That's why all of our asset accounts, all of these asset accounts have debit balances and increase with the debit, and when they drop, they have credits to drop them. Okay, so that things stay in balance. You can see with all our arrows, every time there's a debit, there's a credit. It works that way every time. Over here, we say, well, everything's got a credit balance. With a debit, now it drops. With a credit, it increases. And we've got these two special accounts here. Dividends, as they go up, they get debited. Why? not because they're not equity accounts, but because they drop equity. As I pay out more in dividends, my equity account drops. As I pay more out in expenses, my equity gets smaller. What the owners have claimed to drops. We've got debit balances because they reduce the overall value of equity. So this then gives us our accounting equation. It shows us the debits and the credits, and it also shows the accounting cycle, because the whole idea is when we do our normal entries, part of the accounting cycle, we use all of these breakout accounts, as well as our liabilities and our different asset accounts, right? Then when we do closing entries, what we do is we take all these accounts and we close them back into equity so we can see overall how we've done. And that's the idea. That's the accounting cycle. All of this is part of that accounting cycle. Hopefully this makes sense. The last thing I'm going to mention, if you're still having trouble, even after going through all of this and the logic and the reason and why and how does it work, if you still feel a little shaky on what should have a debit balance and a credit balance, there's a shortcut, an acronym you can use. Okay, and it's DED, color. Debits are expenses, assets, and dividends. Credits are owner's equity, liabilities, and revenues. Okay, so if hopefully the logic made sense and the why made sense, but if it doesn't, then you can memorize our little acronym and it will still work for you. Now, we've talked about a lot. We've gone through an example. We've gone through all these different pictures and drawings. Hopefully, all of this has served to kind of pull together the concepts that make up the accounting cycle and the accounting equations. I hope it has. If you still got questions, though, take a look at an accounting book or come see me or email me and let's talk a little bit more, because you really need to be comfortable with this before we move on to the journal entries, which are what's coming in our next segment. I'll see you then.